All right. Want to welcome everybody into our webinar today. Appreciate you guys tuning in. I think you guys are going to get a lot from today, not only seeing how we operate our business. I'm hoping you guys learn a little bit there, but also hope you guys learn a lot about the opportunity. And there might be some of you who are just wanting to learn how we underwrite and see how we do our deals. But I wanted to kick off today with this post. I actually recently did this with my son. And if you guys have been paying attention to the markets, the stock markets had a rough go as of late. And I wanted to share this kind of with you guys to start off today, as I think it's a great way to kind of frame things up and also get a little bit of a chuckle. But I actually posted this on LinkedIn of my son saying, "Hey, I heard the stocks and crypto markets are getting crushed, Dad." And then I said, "Well, son, that's why we invest in real estate." That's always been a big one for me. I think it's always good to have diversity. I don't think anybody should be completely all in on one market or one asset type. But I'm hoping today, if you guys aren't already, you'll definitely consider looking more into real estate and ultimately understand how to underwrite it and how we've kind of been doing it for years. And you're also going to learn a little bit about our track record. So quick disclaimer, before investing, always make sure you read through the PPM. And there's a lot of other different legal stuff here, which I encourage you to read through. But again, when you come to invest, always understand the risk, understand what all is involved. And the other one to highlight here is to invest in our fund, you do need to be accredited. But if there are people who are not accredited on this call, or maybe you're not sure, I would definitely encourage you to still watch it because you're still going to learn a lot about how we do our deals. And just because you're not accredited today doesn't mean, I think a lot of you guys, if you're not, your probably goal is to be accredited. And I think I always like to bring value to people who want to invest and want to understand how we underwrite deals. So anyway, I still would, and at the end of this presentation, there's going to be an opportunity to book a call with me one-on-one. So I would still encourage anyone, even if you're not accredited, still book that call because I would still love to help you guys. And you'll see a little bit more about that as I dive
Thanks,
into my
Casey.
background. Okay, so for those of you who don't know me, my background, I actually bought my first rental property over 15 years ago. So back in 2010, when I was going to school at the University of Wyoming is when I first bought my rental property. Right. But like a lot of you guys, from there, I went on to work a W-2 job. I actually worked that for 12 years up until 2 years ago, a little over almost 2.5 years ago, is when I finally left my W-2 job with Shell. But I worked just like a lot of you for 12 years in the oil and gas industry. But what I found was, and guys, I had the luxury when I worked for Shell. I was an engineer. And all engineers, they give you a field assignment. So I went out to West Texas. Never forget it. So this was about 2014. I went out to West Texas and I would work for 2 weeks out on the drilling rig and I have 2 weeks off, right? But what that afforded me was an opportunity to start investing in real estate because for those 2 weeks I'd be on the rig, but on those 2 weeks off, I would have zero responsibilities for my W-2 job. And that's what allowed me to start getting into real estate, right? But it was a great, great opportunity. Now, the downside, which I always like to come back to this, and I'll probably come back to this a couple more times today, is when I was working out on the rigs, out in the middle of West Texas, away from my family, it was a great career, a great opportunity. But I always found myself asking myself, but what if I didn't have to be traveling out to West Texas or Canada or wherever it was? Ultimately, what if I didn't have to be away from my family and I could choose my family over work? Right. And I started asking myself this at early on in my career. Right. And it didn't happen overnight to where I was able to finally make that decision and change it for the better. But I started thinking about that early on. And it's a question I want everyone to ask themselves today. What if you didn't have to choose your job or your profession or work over your family? Right. That's one of my biggest passions is to help other people be able to make that choice. And I really want to drive that home. All right. Now, just a little bit more about how I was able to grow and I was able to make that decision was as mentioned, I was working for 2 weeks on the rig and 2 weeks off. And I started buying properties up in Wyoming where I grew up. And what I quickly found was in Wyoming, it was this really unique niche that I found I had in Wyoming because there was not a whole lot of wholesalers, right? But it was a very strong retail market. And initially I was just like, man, I'm getting really good numbers. I've got really good cash flow. My properties are all performing strong. But when I really realized this was when I started to join other masterminds and I started surrounding myself with other high-level investors across the country. And when I was showing the numbers, and because in these masterminds, a lot of times you're very open and you share your best practices, you share the numbers. And when I was sharing this stuff, sharing my numbers in Wyoming, people were blown away. They're like, wow, you're getting those numbers up there? And so that was kind of the first time I really started to realize, wow, I'd found something unique, right? And if you guys are asking why Wyoming, right? Because I live here right now today.
Yeah.
I'm sitting here in Houston. I grew up in Wyoming, right? I graduated from the University of Wyoming in Laramie, where I bought my first rental property, right? But I still continue to invest up there because of that unique niche I found, right? Where there's not a whole lot of investors, not as much competition. But on the flip side, the retail market, in terms of people buying properties or wanting to rent, there's not enough, right? There's a lack of supply. A lot of that's due, there's many factors that are driving that. One of the biggest ones is amount of housing, right? And construction. They just can't keep up with demand. Like a lot of other, you're seeing this across the country, but we see it especially in Wyoming. So one of the first things I did was learn how to find my own deals. Because believe it or not, back in, what was this? Probably 2018, 2019, I had been investing in Dallas Fort Worth and I'd been doing some stuff in Wyoming, but I'm like, I wish I could find a wholesaler in Wyoming, somebody who could bring me deals off market so I wouldn't have to buy everything on the MLS. And I thought to myself, well, I could wait for somebody else to come figure it out how to wholesale, or I could figure out how to do it myself. So I chose the latter. I chose to go out and build out a company and build out marketing and build out CRMs and funnels and all this stuff to start attracting my own deals. And that's what brought me my current company, WYO Houses, which started about 5 years ago, to which we now get all the inflow of deals coming to us first. And I think that's one of the biggest advantages of our fund, which I'm going to talk about a lot today, Bighorn Capital Fund, is that we have the deals directly coming into us, the majority of them, right? I also get referrals from agents and students and other investors all the time, but I love that we have predictable deal flow coming to us. And that was one of the things to this day I'm most proud of building, rather than waiting for somebody else to build. Now, the second component was construction. I just mentioned a second ago that one of the biggest reasons why prices have stayed high and it's been a very predictable market and there's not enough supply is there's not enough construction. There's not enough contractors. So after years and years of fighting this, right, trying to deal with general contractors, trying to get them to prioritize my jobs, trying to get things done on budget, on timeline, what I decided was as soon as I had enough rental properties and enough fix and flips going, I was going to go hire my own guy, right? My own contractor who could exclusively work for me. So that was what I did. And we hired our first guy several years ago. And now today, we not only have him, we have 4 different crews, which I showed here. Let me show you this next slide. These are our 4 different crews across Wyoming. Some of them we've recruited from Houston. Some of them we've recruited locally. But this has been one of the biggest game changers to creating predictability in our fund and in my business, because I don't have to wait like the most other people do in Wyoming. They're waiting 3 to 6 months, maybe longer, maybe 12 months to 2 years to get a contractor to come do their job. We have in-house crews, which allow us to be nimble. It allows us to be obviously flexible. It's much easier to control cost and to control timelines. So another huge component of our company. Go back a slide here. The other big part was property management. Now, if you talk to most people and they ask them about their property management, the majority are not pleased, right? It's a hard relationship between a property manager and an owner because you're not perfectly aligned. And I've actually been a property manager since that first property I bought in 2010, that unit up in Laramie. I still own that property and I still actually manage it. But today I have now a full team of virtual assistants combining with those contractors I just mentioned to you in my COO together. That system or that hierarchy, right? They're able to manage my rental properties. We now today, as you can see in the property management section here, we have 250 doors. We actually have an offer on another 120. So we're looking to expand that to 270 doors and potentially, and if we get that latest acquisition, we'll be up around $45 million in assets under management. Again, all managed in-house. I mentioned I love having the deal flow coming to us from WYO Houses. I love the in-house construction and property management, being able to control that process. Here's one example I'll share with you is anytime that maybe our vacancy isn't where we want it, or maybe we're not getting full market rents, or any discrepancy or any gap I see in our property management, well, we actually plan it and it's part of our quarterly goals. So we always have targets that we're hitting, but say we're off course a little bit. All I have to do is go jump into my team's like daily meeting and be like, hey guys, we're off a little bit here. How do we tweak this? How do we pull those levers? Right. But when you are dealing with a third party company, you can do that. You could be like, hey, I want to change this, but you're dealing with a third party company and they're working with all these other people. So I just love the control that we're able to have over all three parts, from, again, finding the deals to fixing them up to managing the property. All right. Now, this is what is allowing us to set our 2025 goal down here, which is to do 100 deals this year. All right. These 100 deals, some we're going to wholesale, some we're going to fix and flip, but a lot of them we're going to take down in this exact fund that we're talking about today that you guys could have an opportunity to invest in. Now, just take a little bit farther so you guys can get to know me and what drives me, a little bit more about my why. I asked that question earlier about, for you guys to frame that up in your mind, like, what if you didn't have to choose your work over family, right? This has been such an important one to me, and I could go out. I've got a longer keynote that I share about like why I made the choice and how my kids and that impacted me. But what I wanted to focus on right now for a minute is my goal, right? And you can see it right here on the slide. My goal is to help 100 families achieve their financial freedom. Because if they can achieve that financial freedom, that's what's going to give them the choice of choosing family over work, right? And it's still, I'm not saying everybody needs to go leave their W-2, but I at least want to give people that option. Any questions, guys? So far, I haven't got into the nitty gritty part, but I wanted to, for those people who don't know me and what kind of my goals are, I wanted to dive in deep here. So again, my goal is to help 100 families achieve financial freedom. The other thing I have is my podcast, which is shared there, where I'll actually talk to different guests and help people specifically in the oil and gas industry. But we have listeners from all different industries. But again, coming from oil and gas, I've always been able to really relate to those professionals. The other logo up here is Problems to Profits. I know we have a couple people tuning in today that have been a part of that. Problems to Profits is a really cool platform opportunity I was given by Pace Morby and the Sub 2 community to lead a weekly Zoom. This is where I help new investors to help them solve problems and turn them into profits, right? These are operators just like me, and I love it because I get to help them. A lot of these people will actually be part of the 100 people that I want to initially help to achieve financial freedom. They're just going to be a little bit more active, right? But here's the cool part about the fund and why I'm mentioning this today is, again, I mentioned my goal to do 100 deals this year. Well, some of those deals are going to be sourced from students or people in this community that have a deal, but they need help taking it down, right? Or they need funding for it, or they need help with the operations, or they need contractors, right? All these, there's just tons of different students in this community that want to get started, but they need help. So it's been a really cool synergy to bring them in, have them come in on a deal and participate, or maybe we just pay them a fee, or sometimes they just want to learn, right? If they can I can just open the door, kind of pull back the curtain and show them exactly how we do deals. It's been a really cool win-win. And I share it with you guys today to, again, show you how we're involved in other different communities, how we love to help different people. And the last part is how we have constant deal flow coming into our pipeline. All right, let's get into some of our case studies. All right, I gave this presentation a while back, and somebody told me I should coin the term, instead of case studies, we'll call them the Casey studies. All right. These are all deals that I've done, and I wanted to share several of them with you guys today. Some of them are pretty cool, and I've actually got some video and some photos to show you what it's all about. But ultimately, this is, when you guys are looking at and investing, I think it's very important that you know the operator's track record, right? This is something I've worked really hard over the years on, and me and my team spends a lot of time being able to present them to you. So I'm hoping this helps you guys feel more comfortable, but ultimately gives you an opportunity to go do your own due diligence, okay? The biggest, maybe best one that I'd love to present that I'm going to lead off with is our track record. We actually have this Google Sheet. This is a screenshot of it. All of our investors will get access to this Google Sheet, and it's got, this has over 125 or some deals. We're actually adding into it every day of deals that we've done over the past 15 years, right? As you can see it, I share what we did with it, my LLC that purchased it, the address. You'll see too, I actually link the sales price. This is actually there's like 5 to 10 more columns, actually maybe even 15 more columns over here to the right. But I like to link all of the settlement statements. That way you guys can actually go look on the public records and see proof of deals that we did, right? Because everybody could say they've done all these deals, but I learned this from a mentor a while back. He said, Casey, if you can't prove and show with documentation all the deals that you've done, then you might as well not have done them, right? If you can't prove them, they mean nothing. So I've actually taken the time to have this readily available for you guys to go in and dive deep, and you can actually see how much our investor made, what the payback was. And in some instances, we have before and after pictures. but this is a really cool resource that I've gotten feedback from many of our investors who invest with us. They love the fact that this is so readily available and they don't have to go track it down, because their feedback is a lot of the other investments they've done, they've got to go hound people and try to track this down. So they really appreciate this. Additionally, if you guys just want to go like kind of see it and feel it, you could go to my YouTube channel, right? This is just a screenshot of several videos of fix and flips we've done. And I love just sharing what we do. So I encourage anybody to go to our YouTube channel today and check out more of the deals we've done. I'm very transparent. I love sharing this stuff. So you guys can go look at it, see it firsthand. Yeah, again, you can see the numbers if you're looking here, right? And this is where you can kind of go see like the stories behind these different projects, okay? Now, I want to get into a couple bigger case studies and actual funds that very much relate to this offering that we're going to talk about today. Now, this first one was an equity fund I did in 2022. I did this with another partner. We actually structured it so similar to what I'm going to offer you today, where we had a mix of single family houses. We're doing some fix and flips, and we had our big flagship property, right? So this is just some of the single family assets. The cool thing is I underwrote those the exact same way that I'm going to share my underwriting with you guys today. So I just wanted to show you guys, I've been doing this for years, and it's just worked really well when working with other partners, okay? Now with this was the big property. This was one of the ones I'm most proud of, and I'm going to show you guys a really cool video in a second. But just to give you a quick breakdown of the numbers, this was a 66 unit. At the time, there was only 63, but we've actually bought a couple more because they're actually, all these units are individually owned. There's 72 units across 3 buildings, all right? Now, this was our purchase price. This was our most up-to-date rehab cost, right? So if you look at the average cost per unit, we put about $15,000 in, right? But check this out. We actually already have units that have appraised individually they're appraising for nearly $100,000, or sorry, they appraised for $90,000. And actually it looks like our up-to-date appraisals are going to come in higher, right? So this is actually a pretty conservative number. So in this deal, if you look at across these 66 units that we bought, based on what we bought it for and what we put into it, we created nearly $2 million of value, right? Really, really cool deal. And I want to show you guys a quick video of this deal, okay? Let me show it with you right here. And for those of you who are going to be watching the recording, you'll be able to get a full link to a little bit longer one. This is actually a 6-minute video that walks through this deal once we are all done. But I wanted to show you guys just a little clip of it. This is a project I'm so proud of because it took us a couple years. We did so much. We renovated 55 units. And in this video, I kind of talk about it and I show you guys some before and after. But anyway, here's a little bit about it. Now, before I get into the numbers and how this all worked, I want to back up and talk to you a little bit how we underwrote this deal from the start, right? And I do this on all of our multifamily assets. I like to show a low, a medium, and a high case, right? Because when I'm presenting this to other investors, or this time it was my business partner, I want to show them, hey, this is what we could potentially make, but here's what I always like to be like, hey, if we're super conservative, could this thing still cash flow? Could we refinance? Does it make sense as an investment, right? And if we hit our high scenario, then heck yeah, everybody's excited. But on this one, I did something unique, right? I not only had my low, my medium, and my high cases, right? But then I had what I called my STR high case. That means short-term rentals. Because I knew there was an opportunity based on other assets I had done to basically come in here and make several units into short-term rentals, right? And the short-term rentals have more cash flow. So that actually increased the high scenario. Guess what, guys? We are not only hitting the high scenario, we are hitting the short-term high scenario because of these 8 units on this floor. Let me show it to you. So again, we decided to make one floor, all 8 units look just like this. You can see they're beautiful, right? They're fully furnished. And now we have them leased out on as medium-term rentals for maybe nurses, maybe working professionals month to month, or even some people are signing a year lease, right? And the other thing is we're doing short-term rentals through Airbnb. We have a mix of that to keep it occupied. This, guys, the numbers on this, we're actually starting to see this already, and we've only been doing this for a couple months. We're seeing 1.5 to 2x the amount of rents on these short-term rentals. Now think about that. Think about what that does for your asset, because a multifamily asset is valued on the NOI, the net operating income, right? So now when we go look at these 8 units that are getting 1.5 to 2x the rents, guess what that does to our net operating income? It raises it.
Guess what that does to our value, right? So when we go to refinance this, this should increase it that much. Or if we were ready to go exit this, this could make even more equity and even more profit on the deal, right? So to wrap this up now, I've explained how we've nailed all of our numbers, how it's been a huge success and created a ton of equity for me and my business partner. But guys, honestly, what I'm most excited about is how we've completely changed this community, right? I've told you guys the stories I've heard from the police department. I've heard it from different tenants. I've heard it from, actually, my contractors tell it to me all the time. They talk to people around the city of Casper and they're like, we love what you guys have done with Hillside Casper. It is completely transformed. You guys can see it. Families are here, right? People are actually able to come live here and feel safe. And in Wyoming, there is a huge need for affordable housing, right? There's a huge need for clean housing and there's just not enough supply. So the fact that we were able to bring these 66 units to the market, improve the exterior, improve the common areas, and make it a safe place, that means the most to me.
These are some of the short-term ones that we furnished. It's a really cool project. The exact strategy we did on this multifamily, where we turn them into short-term rentals to increase the cash flow, that's the exact strategy we're actually doing on our big multifamily asset that we're taking down in this fund that we're actually, you guys are having an opportunity to participate on today. All right. So I really encourage you guys to go watch this. It's several minutes long. It'll give you guys a really cool story of what we've done. So that was the first big kind of equity offering. The second big offering we did was actually at the end of last year. And this is why today, guys, when I show you guys the timing of this, why it's, I think, important if you guys are interested to jump in. This one we put out right at the end of 2024. A big reason was to help people with depreciation. This one is actually filled up by a group of, it was a group of 3 different investors that ended up funding the $2 million for this asset. So this asset was, again, very similar to the last one and the one we're offering today, where it was a mix of single family and small multifamily assets that were already cash flowing, right? And we were also going and buying other larger multifamily that had a lot of upside and has a lot of future appreciation because these are in markets where we believe they're really growing. Okay. The other component of this fund, which is similar to today, because you're going to see a lot of parallels, right? The other thing we're doing within this fund is fix and flip, right? To where we can not only cash flow the properties, but we'll have some fix and flips coming in that are going to increase the distributions. So this group is really excited, is me as well. This one we put together at the end of last year. I'll probably make sure everybody is muted if you guys don't mind. And then we'll definitely have some time for questions at the end. Now, the next offering, this is one I did within Bighorn Capital Fund. And this one we started about, a little over a year ago. This has been another great project that I'll share some videos with you guys so you guys can see the project. Actually, was just walking this property last week. We raised $1.7 million for this one. And it's a great multifamily value add where we renovated there's 45 units. We renovated, it's shown here, 30 of the units we're actually renovating. But the numbers are coming in so great on this one because, again, we buy in these markets where they're underserved. There's not enough units, right? And we're already starting to hit like our high numbers because we always do a low, medium, and a high when it comes to projecting our rents. And this one, it looks like we're hitting our higher, the higher projections, which is really exciting. We actually, I think, have some people in our fund that are looking to do this offering with you guys today that participated in this exact one. So that's really cool. All right, now let's get into our current offering. All right, I'm going to dive into the underwriting in just a second, but I wanted to show you guys sort of high level what to expect. All right, so the projected IRR on this one is 20.45%, and I'm going to show you guys how that is all calculated. The plan, though, is to hold this over 5 years. But again, it's not a firm 5 years we're exiting, mark it on your calendars. That is a target, right? If we have an opportunity to exit sooner and make a great return for our investors, we will look at that. Also, if after 5 years rates are high and it's not a good time to sell, we could hold longer. All right. We will be doing distributions quarterly. The cash on cash return is 8 to 70%. And you guys are going to see that. A big reason is because of the fix and flips that we're doing. Minimum investment, $50,000, and initial target raised is $5 million. Okay. You guys ready to see the underwriting? I'm going to break this down for you guys. For any of you Excel nerds or people who love diving into the underwriting. Here we go. And this is a spreadsheet, guys, I will give you access to. You can obviously go back and watch the recording a second time if needed. Now, these are specific assets that are already identified, right? And I'm going to show you this multifamily one in a second. This one, these 29 units in Wheatland, that's really the cornerstone of this asset. So you can see, actually, let me go into this, the underwriting of this deal. So as mentioned, I always like doing a low, medium, and high cases, right? So there's 28 studio apartments on this one. And then there's one larger, like 4-bedroom, 2-bath apartment. So you can see these are the rents I'm projecting. 450 is like, that's like, some of you guys who are investing in other markets or no rents, you're probably going to be like, 450, that's it, right? And that's extremely low. And you guys will see that some of our numbers still work in the low case. I ran our projections based on the medium, but very conservatively 450. We're looking, medium case is 600 a unit, high case is 750. I believe based on these short-term rentals and what we've been getting lately, I think we have a great chance to hit our high scenario. Okay. But I wanted to show you guys numbers either way. This is actually the cash on cash return based on each one of those scenarios. Okay. So there's a lot more in here about like how much the taxes and insurance and all that other due diligence is. And you can see how all that factors into the numbers. But I wanted to show you what this one looks like. I did want to share one other video too with you guys, which was on my Instagram. So let me pop over here to the next one. Okay. So this is the Wheatland multifamily. I just posted this. So I encourage you guys to go to my Instagram and watch this quick little reel. You guys probably won't be able to hear it, but I'm just going to give you guys a quick summary. Okay. So this will be another link I can share with you guys, but this is what these apartments look like. Okay. Motel, Wyoming Hotel Inn. I want to show you guys this 29 unit value add we're doing. We're actually just walking through today here in Wheatland, Wyoming. So could show you guys kind of what are the units. So where we're at in the process is we are under contract. We're still waiting on the bank. We're actually still raising money for this deal. We're going to take it down within my fund. I'm actually doing a webinar early next week. So by the way, if you're interested in partnering on a deal like this, be sure and you can comment below or you can shoot me a direct message. I'll give you a link to that webinar. But I want to walk you guys through for anybody who's thinking about multifamily or just wants to learn on like how we do value add, right? So a lot of people are probably looking at this. They're like, wow, you found another doozy, Casey. But these are the best ones, right? This actually particular asset was one that the current investor, like they I don't know if they necessarily just ran out of money or they ran out of resources, but either way, they weren't going to finish it. And I'm like, we've got a crew. We could come in here. And as I'm going to go show you in a second here on the other side, like the other units are already renting out. And the cool thing is we're going to keep these all as studios, right? I thought about blowing these out, blowing like this wall out and making these like 1-bedroom apartments. But then we thought a little bit more. We did a little bit more sort of market research and we realized that we can keep these as studios and we can keep them priced low enough to where we're going to have a ton of demand, right? When you guys look at my pro forma or I always do my underwriting for me, myself, and my investors on this. Like I have a low case, and the low case is like $450 a month. And when you see what they look like fixed up, that's like that we're gonna get that all day. But that's my small low case. I think my mid case is like 600. Then I think I got 750 to 800 if we rent these out as like furnished rentals, and we're like really maximizing. So when you look at the numbers and you guys see the price that we bought this thing at, it's gonna blow you away. All right, let's go check out the rest of the property. It's a doozy. Check it out. So 29 different units here. You guys can see the beautiful Wyoming Motel here in the background. This should be a historic monument. So now down here next to our Pepsi machine, some lucky resident is going to get this nice apartment that's going to be completely remodeled, and we'll throw in the Pepsi machine. And even better, the pool. Who does not want an outdoor pool in Wheatland, Wyoming in the middle of winter? To be honest, not actually sure what we're going to do with that, but it's got a really nice fence. We'll find out something creative. Now let's go check out this unit. Is one of the ones that's been remodeled. So I mentioned this, that we've already got the proof of concept. They're already renting these units, right? And if you check them out, they're in good shape, right? Let me flip on the light for you, okay? So these are the little studios. This is what it looks like put together. We got a little tiny kitchenette back here, a bathroom, and there's actually laundry on the other side. So you guys can see it's a nice, cute little unit. And one of the best parts is when you go renovate units like this, they're small, right? It's not a whole lot of flooring, not a whole lot of paint. And furnishing these things is actually pretty affordable. When we start to look at the numbers, I'm telling you, you guys, if you're looking at bigger deals or bigger multifamily, the numbers are tough these days. But the price we got this thing at and the amount of rents we're going to get, it is, yeah, you guys got to see it. So the biggest thing is tune into the webinar next week and you're going to be able to see the exact numbers. And you guys could participate on it, even if you're not sure if you want to participate or ready for it. You just want to see, hey, how does Casey
underwrite a multifamily deal and how does he put together and structure his fund, send me a direct message and check it out.
As you can see there, we will be splitting these into 2 different units. We thought about making them like 1 bedrooms, but just based on supply and demand, there's not enough in this market, and honestly the cost, and there's just a lot of other drivers. We've just found, here's the biggest thing I found in these small towns over the years is people would rather have something cheap than pay more for something bigger, because there's just a lot of working class people that either A, have a budget, or B, they just want to keep more money in their pocket. So you think about the workers who are traveling and they get a per diem. What we found is they would rather stay in something much cheaper and be able to pocket that extra money than go stay in something very nice. Okay. But granted, these units are going to be really nice. They're just going to be small, but that's what I think is going to help us hit our medium and our higher projections. But this is just a kind of a cool video to show you what the asset looks like. Just want to give you guys a visual of what this actual asset is going to look like. Now we'll get back into the underwriting. I'm sure a lot of you guys are tuned in today, excited to see exactly how we underwrite and do our deals. And I'm happy to share this sheet with you guys. So if you guys are looking at my spreadsheet, you guys could see, so that is the 29 unit. This is really the cornerstone of this fund, or at least the cornerstone of the first raise we're doing. The first, so we're doing these in different sort of tranches, if you will, or different segments, right? But this is going to be all part of the first raise. Okay, so you can see the 29 unit, it feeds into this. But what I've also done on this spreadsheet, everyone, is I've shared several different properties in here, and I've done the full underwriting. Like all these are actually current assets that I own, that I know the predictable cash flow, right? We know the market rents. This is what's already coming in, right? So we can start to predictably do these ones. I've got photos and links in here if you guys want to do some due diligence. But then these have existing debt, right? Because a big part of this fund will be using leverage, right? But the beauty of some of these properties are my interest rates are very low on these ones. They're generally between 3 to 5%. Some of them might even be like 0% because I negotiated really good terms with my seller. Okay. But we've got property. So we got payment. These are all my expenses, right? From my mortgage, my taxes, insurance, utilities, right? And then I have kind of our predictable ones, right? So we will, within the fund, this is all this in our documents, we'll be paying 7.5%. It'll be my property management company that will be doing that. I projected 10% vacancy in Wyoming. Guys, across my portfolio, I see much less than that. We see less than 5%. Our actually target as a company is to be 2 to 3% vacancy. But I've been conservative on our numbers to go all the way up to 10%. I've also got a budgeted in repairs at 10% here, okay? So this number is giving you what is the estimated cash flow on each of one of these properties, all right? Now, the rest of it, we start to figure out, okay, what is the actual pricing of these properties? So what I've done is I've actually gotten appraisals to figure out from a third party to go verify, hey, what is the market value of these properties? All right, so that's this. This is the current mortgage amount, right? These are mortgages I already have in place. Or, for example, on Wheatland, this is actually a loan that I've already got terms for. But all these other properties are actually already in place and they're already cash flowing. But the Wheatland one, we're closing here at the end of this month, the end of April, okay? So that's how we come up with the cash needed, right? And this, if you guys are wondering, of this first $1 million, it's actually just over $1 million. It's about 1.195 million. So if you're wondering how we're going to allocate those funds, the first $1 million, I wanted it to be predictable so you guys could know what to expect. Now, granted, before we close this fund, a property, 1 or 2 or whatever properties might be dropped from this, but you'll know which ones they are. But I wanted to give you an underwriting of so these are properties that will be planned to move in there, plus or minus 1 or 2, right? But then you can know what to expect over the life of the fund. Because again, we're just showing you guys the first $1 million we're raising right now in this first part of the offering, right? We'll be continuing to raise, but I wanted to give our investors a feel for what can they expect? What type of returns, right? What kind of properties is Bighorn Capital Fund looking for and identifying? So you can see here, this is where the money comes in. This is the actual investment from the fund, right? So this is easy math. All this is we're just taking the house at market value minus the current debt, right? And that is the cash that's coming in, okay? Now, in the case with the Wheatland one, it is, this is the total purchase price. This is the mortgage amount, right? So obviously the equity or the cash needed is $234,000. Now, we also have a couple other things worked in. We've got some reserves, right? We want to have, it's very important when you're a buy and hold investor and planning to hold over time, you need to have some cash reserves, okay? Now, the other thing is, I mentioned this on a couple other funds and case studies, is we're going to be doing fix and flips. This one has me as excited about any offering in this, the fact that we can go identify properties. And I think this is a very opportune, very, very opportune thing right now in the market, because every year we find this, it's a very cyclical market in Wyoming, where everybody right now, so today we're sitting here in April in the springtime, everybody's finally ready to sell their house, right? They've been kind of hunkered down all winter and nobody wants to move in the wintertime, right? Also, no buyers are really out looking in the winter. So what we find is right now is a great time to go out, get properties, fix and flips under contract, fix them up, and then we'll try to get these listed by June, maybe July at the latest, and still be able to flip them by the end of the summer. So that's what creates a lot of revenue that's going to be coming in from our fix and flips. But here's the thing. One of my biggest lessons I've learned over the years is always have 2 exit strategies, right? And I love this opportunity with the fund, because if we can fix and flip those properties that we buy over the next 30, 60 days, and we can flip them by the end of the summer, awesome. That's just going to increase our distributions, and everybody's going to be super excited about that. But on the flip side, let's say that interest rates go up, or this crazy stuff happened with tariffs, really maybe it impacts the real estate market, which I don't think it will, but you never know. If that happens, guess what? We just hold on to those assets, because I'm underwriting these deals, these fix and flips, to where we could hold on to them, right? And they might not throw off a ton of cash flow, but at least they should be able to stand on their own, and we can hold on to these assets, right? And we could play the long game, because when I mentioned about the fun and why I'm so excited about fix and flip is when you're fixing and flipping, the only risk is that you just don't time the market right. Well, there's also risk with contractors and other various things. But what I like about that, we're able to mitigate that sort of timing risk, because if it's the right time to sell this summer, great. If we want to sell it next year, great. If we want to wait 5 years, we can still do that, right? Because we're still finding deals. We're buying properties at a discount, which fundamentally, if you buy properties at a discount, you buy them in strong appreciating markets, that is a recipe for success in real estate. Okay. So let's kind of go back here now to the numbers and how they all kind of feed into our IRR projections. Okay. So IRR, for somebody who might be new to funds or investing in syndications, the IRR is the internal rate of return. This is a apples to apples number. So you can know, okay, for example, if you put 100,000 in the stock market, or maybe you put 100,000 in a bond and you were getting a 5% return, you would expect to get, after year 1, you'd have 105,000, year 2, you keep going on and on, right? So it's to give you an apples to apples comparison on what would this investment, how would it stack up against other investments, right? Whether they're debt or whether they're equity or it's a stock market. But again, I would argue back to our first slide in the stock market, if you were planning on getting that return right now and you need the money, your value just significantly dropped, right? But real estate, we feel much better because it's much more predictable, okay? But to show you guys the returns, we're predicting a 20, like in this scenario with these up-to-date numbers, right? It slightly adjusts if you pull out one of these properties, but within reason, it's bouncing between 20 to, I've even seen it as high as 30% in some of my different scenarios. But right now, all this is taking in is this is assuming in year 1, this is the amount of money that would be going out, right? This is how much money is being invested. It's the 1.19 million, right? That's what's coming. It's called year 0, right? That's the initial investment. Well, after year 1, we're predicting 202,000 of distributable cash flow to come in. This is year 2, year 3. And then on the very back end, that's when all these properties are sold, right? Because let me just show you that number over here where it comes from. I wanted to project appreciation, and I was very conservative here on a 3% appreciation. In a lot of these markets, we've seen 5 to 10% appreciation over the last several years. Do I expect 10% like we've been getting? No, I wouldn't expect that. But do I expect a little more than 3? Yes, I do. But I think this is a good conservative number. So this is just saying year over year, the value increases by 3%. So this gives you the exit price after 5 years. Because after 5 years, we will have appreciated, we will have cash flow and all that. So basically what I'm taking is in year 5, when we sell all these assets, they will have appreciated 3% per year, right? But plus every year we've been getting this cash flow. So again, this column here in Q, this is cash flow by property, right? You can see it each year. Actually, for my fix and flips, I'm projecting $100,000 of profit per year from just doing the fix and flips, okay? So if you add all that together, that's how we come up with the cash flow year over year. And then I also, a couple other assumptions, if you guys really want to get technical, is rent appreciation. I'm assuming 3% rent growth each year, which again, I feel is pretty conservative based on past history. And the last thing is when we sell it, right? I actually factored in the percentage of the disposition. Hold on, where did I put that? Because when we go to sell all these properties, which I'll get to later on, we want to work in a disposition fee, right? For whether we're paying agents or whoever we're having to pay. But I think I worked in, let me see it right here. Oh, here it is. Disposition commission. So I've worked in 5% on the very back end. When we sell everything, we need to be prepared to pay commissions. Okay. So all those factors are worked into the cash flow over 5 years, coming out to 21% return. The last one I wanted to highlight was the cash on cash return, right? So this is what we would distribute each year, right? So year one, we're looking at 14, almost 15%, now about 15 and a half, 16 and a half, all right? But you see the big return is on the back end, which again, if you're tracking and have done deals like this probably makes sense. But for some of you guys might be like, why is there such a big return on the back end? Well, that's because that's when we sell everything. That's when we realize all this, the exit price, the appreciation of buying these assets, right? Over time. Okay. So that shows you guys the full underwriting of that. I am going to pause here and let you guys ask any questions. We're going to have more questions at the end, but I just went really deep on underwriting and I want to make sure you guys understand it. Anything so far? Well, I'll give you guys a chance at the end as well to ask any questions on underwriting. Okay, but you guys can see it all here. So now I want to get into sort of the preferred return and the waterfalls, okay? So now let's talk about the preferred returns. This is a really important section because some of you guys might be like, well, how does my investment work based on my investment amount? So what I wanted to do is I wanted to incentivize people who not only came in and invested early, but also people who invest higher amounts, okay? So you would be an A-class share, which gets a 14 pref. Now, if you guys are investing in other funds or other syndications, this is about as high as I've ever seen in terms of a pref return. So again, if you invest $250,000 or more and you're part of our first $2.5 million, you would get a 14%. I'll tell you guys, anybody on this call today, which I'm going to show you in a second, you guys all will be fine if you get in on this first wave to get the early investment bonus, which is 2% of your pref. Okay. So let's say that you only invest 150, you'll get the 12. All right. But if you only want to do our minimum of 50,000, you will get a 10 pref. All right. So these are the preferred returns. And if you guys are wondering what a preferred return is, that means you guys of the distributable cash flow, 100% goes to you as a limited partner. Okay. There is a management fee that obviously I take, standard to most other funds. But after that, the first 100% of the distributable cash flow goes to you as the limited partner before me as a general partner on the preferred return. Okay. Now, after we hit that 14 or 12 or 10%, depending on where you land, the next split of this waterfall is 80-20. So at that point, you're still getting 80% of the cash flow, and me as the general partner, I get 20%. Now, once we hit 22%, and again, that's across the board. Once you've hit a 22% return, that's when we start to split 50-50. And I did this very intentionally to where I just really wanted to ensure the investors got paid out a high preferred return first. And I wanted you guys to be getting 22% before I really started to get my money, right? But again, I wanted to align ourselves to where I'm incentivized to work hard, and then I get a bigger piece on the back end. But again, that's once I've delivered a 22% return to the investors, that's when I get to start to participate with you guys as a general partner, 50-50, okay? Another thing is, if anybody, let me ask out there, is anybody interested in bonus depreciation or needing or wanting to invest in real estate for the tax benefits? Well, if that's you guys, this will be of very much of interest. So within this fund, and this is a tax strategy that I use for myself personally. It's really cool. So when I make money on a fix and flip, let's say I make 50,000 on a flip. All right. Anyone else who's a fix and flipper, if they're not buying rental properties, or if you look at any other job and you made $50,000 on whatever, a bonus, or maybe you made it on working with a client. But if I make $50,000 on a flip, what I do is I go now buy a rental property for roughly $250,000 of purchase price. Well, when I go do a cost segregation and take advantage of what's called bonus depreciation, I take that $250,000 rental and I'm able to write off $50,000 in year one, right? Again, this is all round numbers. It's not exactly that. But now think about that. So I have a $50,000, what is called like a paper loss through depreciation. I combine that with my $50,000 profit that I made from my business and it washes out. I have a net zero when it comes to taxes. This is a really cool strategy that we'll be executing on this fund, which is going to, and here, again, this will impact everyone differently, but at the fund level, we should have the opportunity, right? Again, I'm not a CPA, and I encourage everyone to talk to their specific CPA, but I'm just telling you how it works for me is when we distribute cash flow from the fund, because we're buying buy and hold assets and we're taking advantage of bonus depreciation, we actually can write that off in year one, right? There will be depreciation recapture at the end of the cycle of the fund, but in the meantime, you get to keep more money in your pocket, right? And you do have to plan to be able to pay the taxes on the back end. But if not, I always look at it this way: you just got a 0% interest loan from the federal government by using the tax code the way it was meant to be used. Okay, so really cool way to take advantage of bonus depreciation. There are actually some people who write off income that they make in other investments. They're able to write off depreciation from this specific deal against other deals where they're making money. Just like I mentioned, if I make money on a flip, I write it off on a rental. Okay. Now, again, everyone's tax situation is differently, so I encourage you guys to consult with your CPA. All right, now to kind of wrap this up, guys, and we'll get to any questions. Right. So this is round one, and I don't want you guys to end up on the wait list. As mentioned, I'm going to go back to this deal, this case study I had earlier. This deal filled up rapidly at the end of 2024. I had a lot of investors that ended up on the wait list, and a lot of those investors are actually listening to this today so they can jump in our current offering. So I'm encouraging you guys to jump in now before this one fills up. All right. Because we've actually filled up about 50% of this. Again, the first round is already filled up. All right. We're raising about $1.2 million for the first round. Okay. So here are the timelines. We need soft commitments by April 21st. So you got 2 weeks from today to give us soft commitments. Right. And now we're targeting but that's just a soft commitment, right? That's, hey, Casey, I'm good for 50,000, or Casey, I'm good for 250,000, whatever the number is. That is your soft commitments. Now, when we'll actually be wiring in funds and closing round one, we're targeting May 1st. So those are a couple key dates that I want you guys to remember. Again, you guys don't have to memorize this. I'm going to be sending you guys a follow-up email with all these videos and all these resources so you guys can go back and look at it. Okay. But I did note this. So because you guys are part of that first 1.2 million, it's actually the first 2.5 million gets this 2% additional preferred return. So don't miss your chance to get in on round one, guys. Okay, next steps. So for anybody who's watching this live today, or if you're watching the recording, the next step is to do a follow-up one-on-one call. You guys can see it. There's my QR code to book it. You're actually going to get an opportunity to click on that link at the end of this call as well. But next step, if you have any follow-up questions, book a one-on-one call with me. Okay. Step 2, you're going to go create an account in our investor portal. It's super easy. I know there's actually some people on this call today who have already set it up and they love it. Our investor portal is great when it comes, and when I get to like how everything works after this, you guys are going to really love the functionality of that portal. Okay. Step 3 is now you're ready. Now that you created your account, you can go put in all your information and you can make a soft commitment. Okay. Step 4 is you'll sign all the documents. And fifth and final step is you will be wiring funds through the investor portal. Now let's talk about post-funding. After you funded, you're in the investment, you're excited, you didn't get put on the wait list, and now you are investing in Bighorn Capital Fund. So first thing, we do quarterly distributions, right? So we're closing this out now. So you were looking, you know what, I'm not going to say the exact date because we might do it 3 months from funding, or we might stay on a quarterly basis. We have not locked that in, but you can expect quarterly distributions. Number 2, quarterly investor updates. I wanted to actually show you guys. Did I put that here? That's not working. Okay. So this is a video too, where I've shown, if you guys are a part of our other Lilac Way investment, you've seen that we do quarterly updates. We actually usually do a video call just like this on Riverside. So if you guys want to go back and watch some of our own investor calls, you can, but we will be doing quarterly investor updates. The other thing is in the portal, right? So when come tax time next year, when you're ready you're going to be like, okay, Casey, we need our K1s. Well, here's the beauty. They're all handled through the portal, right? So you're able to get your K1s in the investor portal. And here's the last thing, which is really cool. If you guys do jump in on this first wave of the fund, you guys will get priority registration to a 2-day May workshop I'm doing. So it's going to be right here in Houston, Texas. This is really cool. As you guys saw at the beginning of the call, I was talking a lot about my goal to help 100 families achieve financial freedom. Well, this is going to be one of the best ways for people to get started is we're doing a 2-day workshop here in Houston. You guys are going to literally, we got this, one of my favorite parts and favorite outcomes of this workshop is we're going to go through this 1-pager exercise where you plan out your goals 10 years from now, right? You're going to have to, we're going to spend time really looking forward about what are your goals? Where do you really want to go? Because everyone's different, right? This is going to be a very custom exercise, right? It's going to be like a workshop. So you're going to think 10 years in advance. And once we get those numbers, we're going to back it out. Okay, what does that look like in 5 years? What does it look like in 3? And we're going to break it all the way down to a 90-day sort of priority list that you're going to do to start taking those steps to creating your financial freedom. So that's all going to be part of this face-to-face workshop we're doing here in Houston, Texas. And if you guys jump in on this, you guys will get priority registration. Okay. If you guys want any more resources, I'll be sharing this as part of the post email. This is a link to, this goes a lot deeper into like more about our company, how we underwrite, right? How we do our due diligence, how we do value add, how we mitigate risk. It also talks a little bit more about alternative investments and why real estate is a great opportunity. So if you guys want to go deeper, I encourage you to go watch this webinar. It's about 30 to 40 minutes and you'll get even more detail on us and exactly just a little bit more about our company and what our fund is all about. I'm going to give you guys one frequently I get while you guys are maybe thinking. Here's a frequent one I get is like, what does the exit strategies look like? So if I share this one with you guys, there's several options for when we could exit and how we would exit, right? One simple way that everyone could probably understand is we would just go list all of our properties on the MLS, or we could sell them to our cultivated buyers list. That's why I worked in those commissions on the back end, that 5%. If you remember in the underwriting, that's accounting for when we go to sell all these. So that's one option. Another option is we just refinance and we've got equity built up in it and the people who want to exit the fund exit. And if anybody wants to hang in on there, they could stay. This would actually have a lot of tax benefits because when we do sell it in 5 years, that will create, because we'll be doing bonus depreciation, right? To kind of kick the can down the road as far as paying the taxes on the gains, right? But if you refinance, you actually can push it even further down the road and continue to hold the assets. So that's a second option. Third one is we just bundle it all up and sell it to a hedge fund or institutional capital, because if you guys haven't seen that in the real estate world these days, it's JP Morgan, BlackRock. Those guys are buying up more and more assets. And I think it's a matter of time before they come knocking on our door in Wyoming. So that could also be another great exit to where we could cash this all out and then go do something bigger and better. So I encourage you guys, you will get a follow-up email with this and a link to book a call. If you guys are ready to go invest on this deal, please do book a one-on-one call. Also, if you feel like you're just not quite ready, you still will get on our email list and you guys can continue to get more updates. And because I know some of you guys might be like, hey, I'm not ready today, but I will be down the road. And this is going to be a continuous offering, right? This is phase 1, right? But there will be more options. So I encourage you guys to stay in touch, even if you're not ready on this one.